Joining us on the phone to talk about the markets is Dan Zwicker of ADM Grain Group. He is in Decatur, Illinois. Good morning, Dan.
Good morning, Dave.
Well, we begin our discussion today, Dan, with soybeans, looking at the March chart. A week ago, we talked about the potential of a head and shoulder chart in the soybean complex, and we were looking at that neckline, which did indeed this week, off of the USDA report, get invaded to the downside. Confirmation of the head and shoulder top?
Well, you have a confirmation of it, of a head and shoulders top. Now, that alone will set up some downside price objectives since it is a head and shoulders top. Now, that doesn't necessarily mean they will be met, but at least anybody that's looking at a head and shoulders formation has got some downside price objectives calculated. The first one would be the depth or the height of the right shoulder, which was like a 1075 high, and if you go from that high down to the neckline, that's $10, so that's like 75 cents. We broke underneath the neckline here the other day, a little bit above $10, let's say 10.05. So the initial objective would be subtract 75 cents from 10.05, and you get somewhere around 9.30 as the initial downside price objective. And the next one would be that you would take the distance from the head down to the neckline, and I think that's in the 90-cent range. And you subtract 90 cents then from like 10.05, and that would get you down into the 9.15 area or something like that, 9.20 area.
And if we were to claw our way somehow back above this neckline, which today would come in right around 10.09 or thereabouts, what would that imply?
Well, it would imply that this break underneath the neckline was a bear trap, and trap the bear. And then that, in turn, then the new sellers that went in down there would have to start buying their way out. And we would then work our way back into the uptrend that the beans have basically been in since early October.
Is this the most valid pattern to keep an eye on in this chart, or are you seeing other things?
Well, I'm seeing a lot of other things. It's not a real neat head and shoulders. I mean, it's one angle or one view of the market. I think probably more important is that we've broken the uptrend line that we've had in place, and we're now down below some key moving average systems that a lot of your index funds do watch. So we'll have to just kind of have to wait and see. But the key here after that big down day there on Tuesday is we need to consolidate a little bit, take a breather, and then you'll wonder. Then you'll decide whether or not this consolidation is just a spot for the market to step down another notch as we go on into next week, or if it's enough to maybe put in a short-term low and try to crawl its way back into the uptrending channel.
The uptrend line drawn through what?
Well, I use a parallel off of the highs and got it connected to the October low and the December low. And in order to crawl our way back into that, you'd almost have to take these March beans back above the 1030 area.
Let's turn our attention then to corn, which has lost a lot of value in the last several sessions. But I guess if you're looking longer term, going back to October, November, is still essentially moving sideways in the pattern it has. It's at the bottom of the range now, but it's still in the range.
It's still in the range for the time being, and we'll have to kind of wait and see how that plays out. But, especially if you look at it on a continuation chart only and connect the October or the early November and the December low points. Yesterday we went right down to that point there at 68, 69. We did see a lot of chart-based buying interest at that level, and that was enough to, the market still closed lower, but it closed well above session lows at that point. So that point is still supportive to a generally sideways type trend, but we'll have to see whether or not that holds.
Is that the continuation lead option month or straight continuation chart? Continuation
lead option.
What else are you seeing in the charts that we shouldn't be keeping our eye on?
Well, I guess I'm watching that chart gap that we left yesterday or the day before. I guess it was yesterday.
7 cents or thereabouts, a little more than that.
And if you don't close that gap within 3 days, then that kind of becomes a measuring gap for a move to a new low.
And how would you measure that gap? I mean, how would you find out the top side of the gap so you can measure the downside? As people are following along with us, when you say measuring gap, what is the distance you look at?
Measuring gap is viewed as kind of the halfway point in a longer-term move. So the high just before we turned down was like 4.25. The midpoint of that gap is going to be 389. So you would subtract 389 from 425. I think that's something like 36 cents. I'm not sure. And then you subtract that from 389, and then you would get a downside price target potentially of somewhere around 353.
Thank you very much, Dan. We'll talk to you again this afternoon.
Very well.
Dan Zwicker of ADM Grain Group. He is in Decatur, Illinois.